Good morning. I'm Josh Strauss with Pekin Hardy Strauss Wealth Management, and I'm here today with Matt Bloom to talk about our most recent Navigator, which addresses the topic of bank deposit and securities insurance coverage. Okay, Matt, how do these types of insurance work? Why is it so important that you decided to do a Navigator on?
Thanks, Josh. So in this country, we have a fractional reserve banking system, meaning that banks only hold a portion of their customers' deposits and then use the rest for generating income, whether that's through lending, investing, or whatever. But as you can imagine, this can pose a problem if everyone wants their money back at the same time. This is commonly known as a bank run, and we saw a textbook example of it earlier this year with Silicon Valley Bank. So bank runs can obviously cause banks to fail. So the government back in the Depression era created the Federal Deposit Insurance Corporation, or the FDIC, to provide insurance coverage for at least a portion of customers' deposits in the event of a bank failure. And this way people can have some confidence that their money is safe and the banking system can continue to function. Again, we saw how important this confidence is earlier this year when we had three of the largest bank failures in American history.
Right. And the FDIC stepped in to protect bank deposits and calmed a lot of nerves. So then, how does this coverage compare to securities insurance?
Yeah, securities insurance is a little bit different, but still really important. The securities brokerage business is different from the banking business in that brokerages can't actually use customer assets for their own purposes like banks do. Instead, they generate their income through fees, commissions, etc. So client assets actually have to be held in segregated accounts that are totally separate from the brokerage's corporate assets. But while this provides one layer of safety, errors and fraud can still obviously occur, which would jeopardize client assets. And so the government created the Securities Investor Protection Corporation, or the SIPC, to protect client assets in the case of errors or fraudulent activity that ultimately results in a loss of client money. And again, the important thing here is that this coverage gives investors confidence that their capital is safe, which is absolutely necessary for capital markets to function.
Got it. So that seems pretty straightforward. So what's the catch here?
Well, there's no catch per se, but there are some really important nuances to these types of coverage. There are dollar limits to the coverages. There are certain types of losses that are covered while others may not be. So it's absolutely crucial that depositors and investors understand how the protections work. Otherwise, they could find themselves in a pretty bad spot in the event of a bank or brokerage failure.
Very interesting. It sounds like there's some critical details for bank and brokerage customers to be aware of here. So I certainly would encourage all of you to read more about this very important topic on our website at www.pekinhardy.com. Thanks so much and have a terrific day.
Thank you.